Hello, listeners. Welcome back to Africa to Alpha, a podcast series by Rate Capital, spotlighting the founders, investors, and ecosystem builders shaping Africa's innovation economy. Each episode delivers candid, insight-rich conversations that unpack the real stories, strategic decisions, and lived experiences behind the people moving the continent from potential to performance. From angel investing and diaspora capital to sector-defining startups and market-shaping ideas, Africa to Offer brings listeners closer to the voices driving Africa's next chapter. I'm your host, Chris Canway, and today we're diving into a conversation that sits right at the heart of what this podcast is all about, the intersection of capital, community, and the future of African innovation. Our guest today is someone who's earned a reputation for cutting through the noise in African venture. Florent Nduwayezu, or Flo as many know him, is an investor at FE Capital, a syndicate investor with EUVC, and a ClimateHack Ambassador in Nairobi. He backs both founders, but only those who can execute. Flo, welcome to Africa to Alpha.
Thanks, Chris. Thanks for having me. I've been following the great work you're doing on social media, and congrats on the great work. Obviously, there is more to be done in the future, but really proud of the work you're doing and being associated with a great platform.
Thanks, Flo. Flo, for the benefit of our listeners, how would you describe yourself?
I would describe myself as a venture capitalist. I have done quite a number of things before reaching here, and originally I'm from actually a very tiny country called Burundi, but came to Kenya for 13 years ago. Started working in management consulting, supporting startups with different things, mostly fundraising and internal operation as a fractional CFO. And this obviously led me towards growth stage investing and debt financing for more established businesses. But I really wanted to work with early stage businesses. So joined the family office, worked on the climate tech side, and then more recently, supporting startups with funds from pre-seed to Series A. Yeah, I think that has given me a very broad view of the space, really, from working closely with startups to working with VCs at different stages, at the early stage, at the growth stage, and in different sectors. I think that's gives me a good background and a good understanding of the space, and yeah, it's really what I'm passionate about: building innovation, mostly in Africa, but hopefully even outside, bringing African solutions to the world. And yeah, it's a great time to build in Africa, also in the world, but mostly in Africa. We have very capable founders here on the ground, young women and men. So my day is just filled with amazing time with great founders. So very privileged to be in this set.
Thank you. Let's start with your journey. I know you kind of touched on that a little bit. So you studied actuarial science, and as you mentioned, you worked across consulting. I also know that you've done some VC and family office, and now you're deploying capital into early stage African startups. Um, what would you say has shaped your lens as an investor?
Yeah, that's a good question. I think it's obviously it's a combination of everything I've gone through, right? Starting working closely with startups. I think when I was basically a fractional CFO for most of these companies, it was interesting to see the internal dynamics, right? Because once you are submerged in this ecosystem as an operator, it's very hard to think through anything outside. It really consumes you. The amount of time you spend talking to companies, to customers, and it really consumes you, and you really focus on that. But obviously, when you fundraise, there is a bigger picture. There's what we like to call VC numbers and VC economics, right? Which is completely different from a startup founder, and sometimes you can have misaligned incentives really at each of these levels, right? So I think Going from that, from working closely with companies to going to the investment side, you realize, that VCs and the kind of economics they're looking at, the kind of, expectations they have for these companies are really, on the high side. And sometimes it's very hard to really understand both sides really. And I think it's very interesting that I have been on both sides. I feel very privileged to have, had the experience to work on both sides. That's one. And then two, VC is also structured in different ways, right? You have early stage, you have growth stage, you have, debt financing. And also that's something I've also had the chance to understand, right? And at each of these levels and each of these categories, you have different considerations. For instance, the early stage founders will obviously, bet more on the team, a capable team with a strong vision, right? And a huge market to build into, while as the growth stage investors will mostly focus on concrete evidence, on how much traction you actually have managed to generate, predictable revenues, right? um, Whereas debt investors obviously more aligned to growth stage investors, but look at things like profitability. Is this company already profitable? Can they service a loan, right? If we provide to them, how predictable are their cash flows really, right? Trying to reduce the risk. Risk differs. I will say risk differs at each of these levels. So having experienced this different side of this investments, I think it gives me a good understanding, and also puts me in a strategic position to work closely, to be a close partner to these companies, and yeah, support them at different stages of their growth.
Yeah, that's really makes sense. And you mentioned risk there, and just looking again at your, educational background, which is coming from actuarial science, and that's pretty much, embedded within risk. Also talking there about traction. I know that a lot of times there is a storytelling bit, but from what I see in terms of your kind of investment focus, you like to look at the traction. There's been one sentence that probably has been attributed to you in the past, whereby you said everyone can teach, right? But what matters is actually
Sure.
making things happen. So not everyone can make things happen, and that's a powerful filter. So
Sure.
yeah, let's go down a little bit more on the traction routes. So let's talk a bit about traction. You've been quite vocal about what counts and what doesn't. Um, so what do you kind of look for before writing a check?
Mhm. Very, very good question. That it's very pertinent right now, especially on the continent. Um, VC on the continent obviously is quite different from what we have seen in other places, in other sides of the world. For most, early stage companies in other parts of the world, having a working prototype and a really strong team, most of the time will get you a pre-seed round, will get you a bit of investment, right? Which is not most of the time the case for the continent. We have seen it in the past, but yeah, but for now, things have really changed, and the reason for that is the African market is quite tough, in the sense that the rate of the internet and tech adoption here is lower than other places in the world, right? Which really delays the kind of traction that a company is going to have in the future, right? So, as a consequence, you really have to balance the traction and the storytelling at the early stage, right? And the reason I say that is, because we have seen in the past companies with, very innovative ways to tackle the market, strong assumptions, either from, their own observations or from things they have seen in other markets. One thing we have done a lot in Africa is to model the other markets, so the Indian model to Africa, the Latin model to Africa, right? Sometimes even the American model to Africa, and try to have a copy paste model. And that hasn't worked. Obviously, each of these geographies have their own specificalities, and yeah. So you have to really adapt to what you're working on. And given how limited capital is on the continent, having some form of validation from the market is critical, right? That's something I always need to get. Are they actually customers who are willing to pay? $1 on the continent. I always joke that $1 on the continent is worth $4 in other places, because companies are just very cash flow conscious, right? So they really want to invest in the right places. Uh, their internal cash, right? So if you're able to make them, pay any form of capital, that's really a strong indicator um, that it's possible to make this happen, right? So I think that's the entry point for most companies, at least having some bit of actual concrete revenue. The second one, I will split it into two. The first one is a huge market, really. As I've talked about, VC economics is just very high growth, very high potential companies, right? So you really need to have a strong market that is available to you, and a capable team that is able to execute on it, right? A strong market, obviously, we try to quantify it in terms of hundreds of millions, if not billions, right? And the capable team, two key areas I usually look at is speed of execution, right? How fast can you ship the product, and iteration cycles, really short iteration cycles, because the startup journey is a discovery journey, really. You try something, it doesn't work out, or it works out, right? But it's more how fast can you iterate, and how fast can you deploy new products and updates, right? Upgrades, really. So that's, I would say, three areas. The traction initially will get investors excited and want to hear more. And then two is, how big is this market? Is it in hundreds of millions, if not billions? And then three, how strong is the team? How fast can they deploy, and how fast can they iterate the product that they are building, right? So I would say these are like the key areas that I try to look at before at least having a deeper due diligence.
Thanks for that, Flo. And just thinking through what you said there in my head, it was just going on. What do you think African founders are getting wrong?
Investors, or the founders or investors?
Yeah, the founders, yeah. Is there anything that you think, I mean, from what you've seen so far, do you
Yeah,
imagine that maybe
yeah,
they're getting certain things wrong, but some are getting some
yeah,
things wrong?
there are a couple of things that I really wanna provide as background and a good foundation to understand what you are dealing with here, right? The stock exchange, the S&P 500, which is the biggest stock exchange in the world, has delivered 20% annual return for the last 4 years. This is a lot of money. Like, this is high returns, right? Um, and this is one of the safest and well diversified instrument of investment out there, right? So basically, if you're an investor, what you need to do is take your money and put it there. This is very liquid money. By liquid, I mean, if today I wake up and I say, hey, that's 100,000, that 10,000, that 1 million I put in the stock exchange, I want you to have it right now. It will take you not minutes, but seconds to get that money back. So it's a very liquid market. And it's a very profitable market, right? This is what venture investors are really facing, not just in Africa, but in the world. If you approach someone, either an institution or an individual, and tell them, hey, I want to invest in startups, the riskiest asset class that there is in the world, you can't promise them 20% rate of return, right? You have to promise them something higher. maybe in the 30 or 35% rate of annual return, right? And you add to that that you are investing not only in established markets, which is the US, which has well-established mechanism. You're not investing in Asia, in Europe. You're investing in Africa, and you all know how external investors view the continent as a very risky place, right? So you're telling them, hey, I know you have a chance to get 20% rate of return very comfortably and very liquid, but no, I want to take you to the riskiest of the riskiest places that there is in the world, right? Right. So you can't just promise them that 20%. It has to be way higher. Maybe let's assume 35% rate of return, right? I invest in Africa. The liquidity is also a problem. It will not take you uh, seconds, as we have initially seen. It will take you 10 years. The fund cycle is 10 years, as we all know, right? So you're telling this guy you can access your money for 10 years, but at that time when you access it, it will have compounded at 30% annual rate of return, right? That's obviously you lose a couple of investors by just mentioning that. And you're also investing in Africa, and we all know the challenges we face, right? And not only to say that, but startups, not just in Africa, but in the world, have the highest rate of failure, right? We'll assume maybe 8 out of 10 companies that you invest in will go down, right? Only maybe 20% will generate good return. So if I'm assuming I have a $10 million fund, I want to return 40 million, so 4 times the money I was given to reach that 35% rate of return, right? And I'm only depend on 2 companies to make it. These companies can be, $20 million, 20 million valuation type of company, 100 million, very close to really having either half a billion or $1 billion type of companies, right? And then that's really a critical thing that founders maybe are not understanding. If I'm building a company and in the next 5 to 7 years, I expect it to be at $5 to $10 million. For most of us, including for me, that's life-changing money. Like $10 million in revenues, maybe you are making 2 million in that's a huge amount of money, right? But unfortunately, this does not align with VC mathematics and VC unit economics. It has to be a huge outcome, right? So that's, I think, one area that a lot of founders are really underestimating, right? How big this opportunity has to be. So that's one. And in the same line, this will drive the sectors and the areas you're focusing in, right? I was talking to an investment banker, close friend of mine, and he was telling me that in Kenya, there are 200 companies that make more than $10 million that they focus on, right? That's a very small pool of companies. So if you are building a B2B company just in Kenya, and the pool of companies you can target is 200, right? I'm sure there are more than that, but these are maybe the ones that are formalized and can purchase a bit of tech-enabled opportunities. Let's say this is your market size, right? And each of them maybe pays you what, $5,000, $10,000. This is not a huge market, right? Even though it seems like it's a big market because all these companies are making millions, it's extremely hard for you to monetize and build this kind of scale, right? So understanding where VCs really want to end up, where they want to land in terms of exits, that's one, very critical. And then two, this will drive you towards the kind of sectors and the kind of areas you should be building in, right? Yeah, and it's not a sin, it's not a bad thing to build something that is not venture scalable, right? In fact, those have higher chances of succeeding compared to venture-backed companies. But if you really choose this game of VC, you just know, it's going to be some hectic 10 years. And even at the end of the process, I know 80% of these companies won't make it there. So choose wisely the areas you decide to focus on.
Yeah, I like that last bit. Choose wisely, and it just kind of flows naturally into the next question I was going to ask you. And it's because, I read a lot of your content, your posts, and your, prayer interviews. So I follow them, and I'm a really a keen fan of yours. And again, one comment you've been attributed to is you've said in the past, African venture needs more discipline. You know,
Mhm.
I just wonder, what does that look like
Yeah,
when you say that?
that's another good question. And um, if again, if actually this really complements what I've just said, where it stops. So we have established that you need to choose wisely the areas you focus on, right? And also you need to choose wisely what you want to build, right? You can just build for a small set of companies. You need to build for a huge opportunity, right? So back to the economics, that if I want to have exits that are very much in line with what VCs want, um, it's going to be extremely hard for a fund that is has hundreds and hundreds of millions of dollars to return 3-4 times the money to generate that kind of 30%, right? So the discipline on the VC side initially comes with um, how big are the fund sizes, right? Can you return that 30-40% that you are talking about annual rate of return uh, to attract commercial investors? This is on the commercial side. A lot of the funds obviously are also impact. They have an impact mandate, which is good, but that's different from the commercial side that we're talking about, really. Right. So how big is the fund? And I think we need to have more reasonable funds, way lower than what we are seeing. That's one. And then two, in terms of valuation, right? How big are these opportunities? We already know the ceiling is limited because you can't have the kind of exit we see in more developed economies. We don't have the established ecosystem compared to the US, compared to Europe, compared to other places, right? And also we don't have the purchasing power that other economies have. So you need to be, conscious of valuation. A good example I like to give is seed rounds in the US on average are somewhere between 15 to 18 million dollars, right? An average seed round valuation for a company. And in Africa, actually, we have seen seed rounds between 8 to 12 million, right? It's not a huge difference if you think about it. The huge difference is that American startups are expected to exit in hundreds of millions of billions in terms of actual exit. And I don't know if African startups can also exit at that kind of stage, right? So as a reason, I think the valuation should be coming way lower than where they are right now, right? So I think discipline should come into those two areas. The fund sizes, how big are they? And also the valuation at which we invest in, right? And I think we are all guilty of it as investors, right? You find a really good company, you love the fund, you fall in love with the soil and everything around it, right? But you're not the only one. Everyone else around you, all these other investors, and the more you all bid for these rounds, the more it drives up the valuation, and maybe sometimes you get carried away and forget how low the ceiling is compared to other places. So I think in the next couple of years, we've already seen a bit of correction in the market, but I think there's still quite a way to go before we land in the right places.
Great, thanks.
Mm.
So let's shift gears a little and
Mhm.
talk a bit around syndicates, climate, and the ecosystem. So you're also obviously a syndicate investor with EUVC,
Mhm.
and you are a ClimateHack ambassador. Um, why do syndicates matter in African venture?
Yeah, it's a good question. Syndicates, I will say, in Africa should play, or as I see them, a bigger role than in other places. A syndicate is basically a group of people who support you at the early stage, angel investors, with some initial capital to help you grow the business, especially at the time when the traction that we already talked about might not be as big for VCs to come in, right? Um, in other places, angels, most of the time, they write to you a check and they're not as much involved. But I think on the continent, what we have seen, a lot of these angels are very strategic, right? They either work for other funds, maybe someone like me, and you basically end up as a pipeline for future fundraising round, um, which is a great value addition. That's one, and then two, they could be potential customers, right? I've seen CEOs of either bigger startups or well-established institutions, you know, invest in early stage nascent companies, and then be potential customers later down the line, right? Or even at the inception stage, right? So I think they are very strategic. Some of them can open up doors in terms of pipeline of clients, in terms of regulation, and as you know, for the continent, regulation has always been a problem, right? In terms of licensing, can help make this process faster, right? A lot of the angels that we see on the continent are very, very strategic. They don't just come with just the cash or the small tickets, but more also with potentially opening up doors in different aspects, right? So yeah, I always try to help my companies if it's in terms of fundraising, in terms of clients, in terms connecting to strategic people can help with regulation and other areas.
Thanks. And then a little bit around the climate base
Mhm.
and yeah, how important is that as well? How important is climate tech for Africa?
No, I think I'm a huge advocate for climate tech, and I know the focus right now is on AI and other areas, but climate tech is really the future for the continent. And I have concrete evidence to this. I'm not just saying words out of everything. I have proof for this. First one is we all know the world has to shift the way we power energy for ourselves, right? Before the podcast, we're talking about climate change, right? It's visible, it can't be denied anymore, right? We need to shift ways where we need to go from non-climate friendly ways to climate friendly ways of, powering energy on the continent, in the world, really. And the continent actually has all these natural renewable resources that could be tapped into, right? A place like DRC can actually power the whole continent with the hydro electric resources that they have, right? Obviously, we haven't tapped into that, but it could be interesting really looking into it, really. So, and it's not just DRC, it's all these countries in Africa. Most of us have really strong resources, right? So that's point number one. I usually see it as the way Dubai, was, or the Middle East in general was, this small place with no much infrastructure, but after they discovered oil, uh, the results speak for themselves. And obviously, if we implement a similar kind of strategy on the continent, there is a strong opportunity here, right? So that's point number one. Point number two, every economy that's ever developed has to go through manufacturing. Think about China, think about India right now, think about the tiger countries in Asia, right? Think about the US with the agricultural revolution and Europe too, UK, right? There has to be some form of manufacturing and mechanization that has to happen, right? And it has been proven that the more a country improves their energy powering and reduces the cost of energy, the more people can dedicate their efforts towards productive use of this energy, which most of the time goes to mechanization and manufacturing, right? So by ensuring that we focus on this part of climate tech, there is strong opportunity for the continent to position ourselves as a manufacturing powerhouse, right? We have huge population of young people. We need to create jobs for them. Obviously, this is the way forward, really. And I think that's a strong opportunity, right? So yeah, for all those reasons, I think climate tech is the future. I don't even see it as a commercial as an impact case. It's really a strong commercial case that could really leapfrog the development of the continent. So really excited to see the kind of solutions that come out of this area.
Thanks, Flo. So,
Mm.
let's close with some advice. And what do you tell early stage founders at this point? Do you have any words for them?
Yeah. First of all, I want to say congratulations. Building in Africa is the hardest thing to do, especially building a startup. But you will be surprised about with the resilience and the creativity, resourcefulness that a lot of these founders have really. Every single day, as I mentioned, I have a first class ticket to see what these guys are doing, and it's just unbelievable the kind of innovation and um, profile of founders that we have here, right? So I just want to say initially congratulations, and then two, um, I say this a lot, even today I posted about it. Distribution is the only differentiator. Distribution will beat a good product every single day, right? And especially in a place like Africa, where you don't have much capital, distribution it's really the main differentiator, right? So ensure that, and by distribution can be understood in different ways, but how do you bring a product to customers in a simple way? And partnerships are always very much encouraged, right? A win-win situation between you and a bigger partner. Distribution is everything really on the continent, right? I could give as much advice, but given how important distribution is, I think I'll just leave it at that. You know, figure out distribution, we'll have won this game.
And given the important role of angels in the innovation economy of Africa, any words for emerging angels as well?
Yeah, definitely. Angels, should provide more than capital, right? And there's already a lot angels are doing, and I will encourage a lot of the angels to be like to really tap into their resources and mostly their network to open up those for founders, right? And as we have already said, the iteration cycle, right? The speed of execution is is the oxygen of startups, really. But they cannot achieve this without access to markets, without access to customers, right? So the more you are able to open up this kind of doors, the better it is for founders, really, and really encourage founders to be a thinking, sorry, angels to be a thinking partner to angels, right? To be the right hand for anything these founders really need. It's it's the right time to build, as I said at the beginning. I know we have been saying this for some time, but this is it. This is the right time to build. More opportunities, a lot of lessons learned, right? And yeah, let's get back to work.
Great. So this has
Mm,
been a masterclass in clarity and discipline and just, founder first investing. Thank you
mm.
for joining us on Africa to Alpha.
Thanks for having me, Chris. Again, a big fan of the work you are doing. We need more of this. So yeah, keep up the good work, and yeah, let's build Africa together.
I appreciate the kind words, Flo. So to
Mm.
our listeners, follow Africa to Alpha for more conversations with the builders who are shaping Africa's innovation economy. Until next time, thank you very much.